Good morning. This is Ken Long from Tortoise Capital with a review of the weekend trading report for January 18th, 2014. We have a market that's in bullish quiet condition on an annual basis using weekly RSI 14. We're slightly overbought at 72 out of 100, with the 10-day NDX assessing the short-term market state. We're in the middle of neutral at 64 out of 100. Looking at the market mosaic, uh, price relative to the 200-day moving average is 9% above, so yellow bullish got slightly weaker. That will happen in a bull market when you have a period of sideways movement while the 200 period moving average is marching up. So we're yellow bullish, about 7% cushion to sideways markets. Slope of the 50 is at white bullish at 0.47. ADX has dropped below the key marker of 15, coming in at 14.2 with bulls in charge. ATR percentage at 0.74% remains quiet. The risk index, which is the 30 period moving average of the VIX divided by the 10 period moving average, comes in with a reading of 1.08, which favors riskier assets or risk on. The threshold is 1.0 on that score. If we take that reading of 1.08 and compare it to the last 5,000 trading days, take the standard deviation of it and call normal as a reading between 1 and -1, we have a z-score of 0.88. You can see that reflected in the 90 days time series here. And we're at a period of improving market conditions for riskier assets. We're approaching the critical state of 1.0. We're about ready to, this would support either a breakout above recent swing highs or a routine retracement back to the Bollinger Band means. So we're right at a critical state in the market there. The blended monthly rebalancing, the current holdings, which will be held till on or about 1 February, you can see reflected here for ETF 13, 22, and 32. They're all doing well with the focus remaining strongly on the U.S. And large caps. The current leaders in different populations as of today are reflected here. So the top section are the ones that we started the month holding. These are the ones that are the current readings for these populations, the top 3 or 5 or 10, depending on which population it is. You can see that the U.S. is still dominating here. In ETF 2, the theoretical exposure is still at 70%. The model itself is at 100%. And here's a deeper look at the ETF 13 and 32 just for reference purposes. 4 symbols in the ETF 13 are on cash, and that's price relative to the 4-month moving average or 88-day. And that's Asia less Japan, Australia, emerging markets, Latin America. So it's the globals are still lagging the U.S. You'll see that same pattern reflected in the 32 ETF portfolio, which adds the sector spiders and more global choices, and the cash positions are being dominated by the globals. So you can see the difference in performance over the last 3 and 6 months between the leaders and the laggards. So a significant divergence of performance here. The ETF Max looks at about 1,300 ETFs and then picks the top 50. The ones that show as white and then green are ones that were leaders and maybe starting to stall a little bit. You can see the Greek 20, for example, only 9.5% in the last 3 months, 50% over the last 6 months. The fact that it's in the white means that it's lagging compared to these other top shelf symbols. The nanotech, on the other hand, is showing green then white. What that means is that it is beginning its period of outperformance on the short term. So that may be a place to look for an emerging leader for short-term momentum plays. Sensitive mouse. There we go. Market health check. Vertical blue lines are 10, 20, and 30 days worth of look back. Horizontal red lines are support levels that used to be resistance. We expect them to continue to be support, but if they are broken through, then they become the ladder of price targets on the way down. The green, yellow, red region is my interpretation of an intuition for strategy. If we break out to all-time new highs, I definitely want to be long and strong on swing trades. In if price breaks below the into the red zone here, in this case below the floodplain at 177, that's where I want to be short the weakest targets routinely. In this yellow zone, this noise area is where I prefer to be with the primary trend, which in this case is up. But if I see intraday movement like these large red candles that are moving counter trend, then for that day only, with no overnight risk, I want to trade in the direction of the intraday market using intraday techniques like the frog and RLCO. So we're at the upper end of that yellow zone. Doesn't take much to break out to new all-time highs where I want to be automatically long and strong. The dark blue shaded area is the 30 period Bollinger Band plus or minus 1. That's the river. And the lighter blue shaded area is the floodplain. That's Bollinger Band 30 plus or minus 2. That defines sort of the limits of recent normal based on a 30-day look back. You can see price is right at the edge of the river and the floodplain, which is where it hangs out a lot during bullish moves up, as you can see its path over the last 4 months. The red shaded area is the dragon plus that's the 10 period Bollinger Band plus or minus a half, so that's about 6 times more sensitive to price than the river and floodplain, and that gives us an early indication of where the underlying current is, or the underlying trend, and that turns in the dragon become significant moments of support and resistance. In this case here, about 25 days ago, when the market had been sideways for 30, it could have voted to move down, and that would have been normal. But in that case, we actually had a strong buying pressure, tested and broke out to all-time new highs, and that became a significant information content there in the dragon. And you can see that it will often provide support levels to price on the way up. The dots are my experiment and visualization with the parabolic stop and reverse as a way to I'm trying to calibrate my intuition on stops by tuning an indicator to it. I'm still sorting through the best set of parameters for that right now. I have it at 0.2 and 0.2 for performance. With 3 sets of regression channels in here, short, medium, and long term, that define boundaries of normal in that discipline. The 10 period regression channel, RAF regression channel, is indicated in blue. The 30 in black, that's intermediate, and the 90 for me, the long term, in green. All 3 are sloping up. You can see the 30 and the 90 are parallel and almost overlapping, and that's just a sign of the long strong bull that we're in. Shows no signs of weakening. The 10 period oscillates a little bit more. It's slightly pulled back because of the selling last Tuesday, but it recovered nicely. It's right in the middle of that channel. So we're right in the middle of an upward flowing river. You can see how the slope of that 30 plays out here in these time series. We're right in the middle of a range of normal on that, so there's nothing overheated about this. This is an orderly, strong bull market, and so the bias is certainly to the upside. The red lines in the Bollinger Band, river, and floodplain give us indications of where that normality could change. You can see finally that where we are with respect to the 200 period moving average in this red shaded area. So we've got about a 7% cushion to sideways. And you can see that ADX is pulled all the way back here below 15. A period of that indicates a period of sideways chop. And so the point would be is that we have an opportunity here for price to leave this basing region around 184 and make the next intermediate term move up, which would look like some of these earlier moves when price began to get directional again. So we're prepared in either direction. The bias is on the long side. In the yellow zone, I'll play intraday. Above the green line, below the red line is where I want to definitely get on the longer term trends. But for now, uh, core and turbo is indicated. Core positions are long and strong in the strongest sectors, and the turbo is used to either reinforce those positions intraday or to hedge against them if the market has sharp reversals like you see in these individual long, tall red candles. We're just coming out of a period of overbought, and the jaws of PPO have opened to the downside, so there is some vulnerability, as we would expect in any long-term bull market that ebbs and flows. ETF2 world market model review here. 7 of the 10 regional indexes are on buy signals, 3 are on cash. That leaves us in the theoretical model at 70-30. The actual portfolio is still at 100 because the stops have not been challenged. The S&P at 73 is better than the globals at 70, so it still favors, the system is favoring the U.S. The two strongest sectors are the technology and U.S. large caps. The two weakest sectors are Latin America at 53 and emerging markets at 58, both in the red, so both are remarkably weak. Inside the U.S., the strength is tech, small caps, large caps, and then mid caps. It's really a toss-up between large and small caps here. They're both at 73, maybe a slight edge to the small caps. So maybe I should have technology and IWM here as the strongest, but it's really kind of a toss-up. The large caps have been so strong, and the sector spiders have been so strong. That's why I tip my hat just for one more week to the large caps. Inside the sector spiders, strength in industrials, technology, and healthcare. Laggards are in energy, staples, and utilities. World market model, the U.S. is all above average, with technology exceptionally so. China and Vietnam very strong, but the rest of Asia definitely lagging, as you can see. Europeans doing very well, all above average, and then still with exceptional strength in Germany, Austria, and Spain. Latin American emerging markets, and really the whole Western Hemisphere, and then all of the alternate asset classes except private equity, all suffering to some degree. The sector spiders, U.S. versus the globals, basically a toss-up, slight hat tip to the U.S., except in the area of industrials where the U.S. is dominating, but then the globals are dominating in energy. So right now it's technology, healthcare, and industrial still leading the way. Top 30 ETFs based on the ETF2 model, which blends strength, consistency, and quality. Um, Biotechs and pharmaceuticals are on a really powerful run right now. Emerging strength here in the biotechs. Again, you see green and then white. Vietnam in green and white is a new leader. Technology, metals and mining, information technology. These are all these things that are green in strength and white in consistency are new emerging relative strength leaders, and so there may be some interesting momentum plays available there. Among the Dow 30, Boeing, um, Visa, American Express, 3M, and Walt Disney, all long and strong, green and green. Merck, ExxonMobil, Intel, Goldman, and DuPont, all green and then white. So that again, that's emerging. You'll notice even the weakest Dow component here, Cisco, is in the yellow. So that's just a sign of the relative strength of the U.S. large caps right now. Those that are green and white are emerging leaders. General Electric, white and green, is a former leader that is starting to fail along with Nike, pulled way back into the pack, and is on one of the few that are on a cash signal compared to the 4-month moving average. So that's our current leadership and laggards among the Dow. ETF liquidity, for your reference, shift now to the daily report to take us into Monday. I'm going to concentrate on pages 2 through 5 as usual. No signals in channeling and overreaction. You can see just how unvolatile that market has been. Hit a recent 6-month low of volatility. but still well into the quiet. No patterns to speak of except a couple for 551W for energy and Coca-Cola, and then the auto framer, a handful that are testing out better than 2 to 1 based on trade location. See the 10-day max pain candidates: Nike, United Health, Chevron, Intel, and General Electric among the Dow 30. For ETF 100, it's the volatility ETFs. Leaders: Visa, Johnson and Johnson, IBM, United Tech, and DuPont. Oops, there we go. Stay with me. Here we go. So the Dow 30 Tactical, um, a handful of channeling and overreactions here. Quite a few to choose from on the auto framer. A couple triple screens to look at, so lots of choices. Have on the RSI2 Nike, which lost almost 2% on Friday and 5% over the last 10 days, a former Dow leader there, has an RSI2 value of 3. Along Walmart and Kmart, Coke, excuse me, both under the critical value of 10. So there's some possibilities for short-term washout and reversals to get back with the upward moves. ETF 30, we got no signals in RSI2. A couple test out on the auto framer pretty well, and then channeling and overreaction in XLY consumer discretionary. The auto framer gives you some mechanical entries and trade frames based on favorable reward to risk ratios. And these, again, this is not necessarily a pattern, but just based purely on. And that's everything I really want to cover. Except let's take a look at the market mosaic here. So the 30 period regression channel looking good. A slight weakening on Thursday and Friday brings the polynomial regression back below the 30. So that's normal behavior when it's in a grinding upward bull. You can see the time series of that slope is still above the 6-month average, so we're still in pretty good shape, though we're right back at the 10-day moving average of itself. So this is a normal resting point, a place where you would normally expect it to find support. And placing that now inside the 10-month or 10-year context. Let's see. Let's look at one more. The regression line z-scores. So the 90 remains strong and above the plus or minus 1 channel and shows no signs of weakening. The 30 has rolled over slightly at the plus 1 standard deviation, and the 10 has pulled back right back to the 0 line. So that is typical behavior of a market that is in a long bull and is comfortably finding support at a relatively high level. We haven't really had a test of the lower boundary of the river for a while. This one got quickly reversed. So it wouldn't be unusual to see a pullback to 175. It would take a breakout below that really to suggest that we would have a head and shoulders here. But this is a good place for the market to be finding support at. So that's everything I want to cover. That's Ken Long at Tortoise Capital. Keep your risk measured and your powder dry.